It's back to school season. That includes for us investors who are back from the summer holidays, maybe wondering where the markets can go from here. Of course, we've been hitting new all-time highs. Well, our featured guest today says there are 3 themes which you want to keep an eye on as we head into the fall. Christian Medeiros, VP Director and Portfolio Manager for Asset Allocation with TD Asset Management, joins us now. Christian, great to have you back on the show.
It's great to be back.
I love how you always parcel these things into ideas for us. 3 ideas, 3 things to watch as we head into the fall. The first one I sort of alluded to, monetary policy.
Yeah, big one coming into the fall. We've had very calm summer. We've had central banks on pause for much of the year. But what we've seen over the summer is deteriorating jobs data. It's not necessarily Armageddon, but we are seeing low hiring, low firing, and slower payrolls over the course of the summer with negative revisions as well. So what this means is that central banks, especially in North America, both the Fed and the Bank of Canada, are now expected to cut rates in September. And for the Fed, cut rates potentially at the next 2 meetings as well, into October as well as December.
When we took a look at those jobs numbers, obviously the Canadian ones were a pullback and a surprise and negative print, very tepid growth in the States. For the American situation, do we feel like this is a blip on the map, or is this sort of a larger trend that the Fed has to pay careful attention to?
We've seen a continuing deterioration in the jobs numbers. There's some noise in the data. We talked about earlier this year how we thought immigration would be a big deal. So we are seeing the labor supply decline as there's a lot of deportations and foreign-born workers leaving the labor force in the U.S. That's creating some noise in the data. The other aspect is the overhang from tariffs are resulting in slower hirings in tariff-affected sectors. But putting that all together, we are seeing weaker jobs data. This could just be a short-term slowdown, and we could see a reacceleration following rate cuts into the fall. But we might see is that this continues to deteriorate and we start to worry a little bit about recessionary data. We did see a bit of an uptick in the unemployment rate with the latest print. So there is definitely some deterioration there. And I think that's the closest thing to watch for markets. If we see much more deterioration, we start to go into a recessionary environment with very different asset allocation outlooks. And if it's just a short-term slowdown, maybe we don't need to worry as much and the rate cuts will kind of extend the cycle a bit further.
Okay, that's theme number 1. Theme number 2 is right here at home, fiscal policy in Canada. What are you watching on that front?
Yeah, so we had a major election in the spring, which we talked a lot about, and now coming into the fall, we're expecting the new Liberal government under Mark Carney to table their budget probably around early October. We all remember that Canada's had fairly tepid growth and productivity leading into that election, and this was supposed to be a change election where we'd have a lot of new policy to kind of kickstart the economy. So during the campaign and since then, Mark Carney's government has proposed spending a lot on infrastructure, improving our military, improving housing, while also maybe cutting back on some areas of the government that are less efficient. But putting that all together, they're proposing to spend anywhere between 50 to over 100 basis points of additional spending per year as a percent of GDP. So it would be a very large fiscal government program, really focused on kickstarting growth. So I think this could be a bit of a big boost for the Canadian economy as well as Canadian asset markets.
It does feel like a different kind of budget, at least in the anticipation, in the sense that I've covered a lot of federal budgets over the years, and you'd look for things like, was there a grant here for this industry, some sort of tax break for another industry, but I never felt like a budget would mean a lot for the Canadian markets. Is this the kind of budget where if they sort of get these longer term plans right, this could be very constructive for the TSX?
I think it'd be very constructive. So I think we should really, let's call it like Build Canada. A lot of the initiatives are really to build out the infrastructure we need to be more productive. So there's one thing that they already passed prior to the budget was something called Bill C5 over the summer. And this speeds up the regulatory approval for building new energy infrastructure, new pipelines, new ports. It speeds up to 2 years from now a multi-year period. So it allows people to build faster, but now what we need is the funding to make that happen. So they want 60% of the new budget to be on new infrastructure. This could be new ports, it could be LNG terminals, it could be new highways, et cetera. And then 40% will go to supporting tariff-affected industries. And so I think it's a pretty big, they're really encapsulating this in building Canada, making us more productive, improving our growth outlook, and unlocking our energy powers, both conventional and non-conventional.
All right, theme number 3, obviously important for us, but important for the world, U.S. policy, the outlook for trade, and some other White House priorities. What's top of mind here? Yeah,
so this year's been crazy for policy, as we're all aware. The fall will be a little bit calmer, but not too much calmer. I think there's a few things that we can look at going into the end of the year. First is we have a government shutdown deadline looming at the end of September, which is the end of the U.S. fiscal year. Expect some noise around this, but I don't expect there to be any prolonged issues. The second one is trade. USMCA renegotiations happen in 2026, but we also have Canada and U.S. actively talking behind the scenes to kind of smooth over our existing trade tensions. So that's something to watch. We may see headlines going into December. The other aspect on trade is Trump may meet Xi Jinping, the leader of China, sometime soon. There's some rumors that they may meet in Korea during the APEC summit. So we may have some new news there on the China-US trade relationship. Then the last one would be Supreme Court challenges. We have Trump's tariffs now going to the Supreme Court on their third round of appeals. And the Supreme Court will decide if a lot of his tariff regime is legal or not legal, and there's big implications of that decision. And then the last one is we do see Trump, who fired Cook, one of the Fed governors. That will also go through court challenges throughout the fall as well. So we'll see whether that's a legal firing or not. And if it is, then the Trump appointees on the Federal Reserve Board would now be a majority going into next year. So that's a big deal for Fed independence as well.
When I think about all these policy changes that we've seen, it feels like a fairly short period of time. One of the trends in the market has been a weaker U.S. dollar. There's even some people who have sat in that chair and said this is what the administration wants. They want a weaker U.S. dollar. If that's the case and the U.S. dollar continues to remain weak, what should we be thinking as investors?
Yeah, I think a weak US dollar is fairly likely. That's a lot of our asset allocation view. Part of that's going to be on rate differentials. We see that the market's expecting the Fed to cut anywhere from 100 to 125 to 150 basis points through next year. So US rates will be going down, perhaps more quickly than the rest of the world. But then on the policy front, if we see erosion of Fed independence, we see the tariff regime being allowed under a Supreme Court ruling, we see the executive taking more and more power, that does kind of erode some of the institutional legitimacy of the United States and kind of does scare away investors at the margin. And that could also result in some weakening of the dollar and also preference for US assets.